Welcome back to Critical Accounting. In this lesson, we're going to take a closer look at the accounting cycle. This will help you to understand the overall flow of information during an organization's fiscal year, as well as the routine accounting activities that are performed at the end of the fiscal year to prepare the financial statements and to get ready for the next year. We'll start with a high-level view of the accounting cycle to get our bearings. Then we'll zoom down into the low-level details where you'll learn how to figure out the various kinds of journal entries that are made during an accounting cycle. And then finally, I'm going to introduce you to an exercise that is available on the course website if you're interested in developing your accounting skills. Let's look at the big picture then. What kinds of activities take place during the accounting cycle and what takes place at the end when things get hectic? Here is a description of the accounting cycle. I'm going to build a graphic representation of this so you can picture it. But first, let's just recall the sequence of activities that we talked about in the bookkeeping video. We talked about recording, organizing, and presenting accounting information. You can see those activities listed here. We also have one additional procedure to consider now, closing the fiscal period. This is just a brief technical procedure that is completely internal to the accounting system, and I'll describe it in a minute. The accounting cycle starts with the opening balances of all the accounts. The permanent accounts will typically have non-zero balances. Asset accounts will normally have debit balances because, for example, the inventory at the end of last period is still there at the beginning of the new one. Liability and equity accounts will normally have credit balances because bank loans and accounts payable and share capital and retained earnings are all carried forward from one period to the next. There can be exceptions to these normal balances, of course. You might be overdrawn at the bank and have a credit balance in your cash account, or you might have had a series of losses that have led to a debit balance in your retained earnings account, but such a situation would not be considered normal. The temporary accounts, including all the revenue and expense accounts, will all have balances of zero at the beginning of the fiscal period because they were cleared out at the end of the last one. Recording the transactions in a journal takes most of the time during the fiscal period because that happens over and over again. The company has to capture every economic exchange that takes place during the fiscal period between them and other organizations or individuals. So this includes sales, purchases, lease payments, employee wages, and so on. Every other step that's listed here takes place only once at the end of the fiscal period. Posting the transaction entries to the ledger means organizing all the debits and credits of the transactions into accounts. We went over this in some detail in the bookkeeping video, so if you missed that, you might want to go back and watch it. Preparing the trial balance simply means listing all the debit and credit balances of every account. This is crucial if you're keeping your books by hand, but it's trivial in any computerized accounting system. The trial balance helps confirm that all the account balances are what the accountant expects, but it doesn't provide the fine detail needed to catch and fix small errors. Next is the posting of the adjusting entries. This includes all the accrual transactions to mark the passage of time, amortization of intangible assets, depreciation of equipment, accrual of interest on loans, accrual of employee wages for any hours worked since the last pay date, and so on. This would be when any corrections would be posted too, if the accountants found any errors in the journals. After the adjusting entries have been posted, another trial balance is prepared to get a final list of the account balances. Once that's done, the company can publish its financial statements. They will reflect all the transactions that happened during the fiscal period, plus all the accruals at the end of the period, the adjusting entries that account for the passage of time. The final step is to close the fiscal period. This is one big journal entry that transfers the balances of the temporary accounts that were used during the fiscal period to the relevant permanent accounts on the balance sheet. Primarily, this means transferring the revenue and expenses to the retained earnings account in the equity section, leaving the revenue and expense accounts ready for the next fiscal period. Every company and organization completes this cycle at least once a year. For small businesses and small nonprofit organizations, that might be it. Larger organizations, though, including all the publicly traded companies, complete the accounting cycle every quarter, so every 3 months. This allows them to present their financial statements to the world on an interim basis 3 times during the year, at the 3-month, 6-month, and 9-month marks, followed by a final set of financial statements at the end of the year. Only the final set, the year-end statements, would be audited because auditing is expensive. The date of the fiscal year-end, by the way, is different for every company. By convention, almost all companies in the world pick one of 4 dates: the end of March, the end of June, the end of September, or the end of December. They could, in theory, pick a different date, but there's no good reason for a company to stand out from the crowd on such a trivial matter. The choice of one of these 4 dates mainly depends on the preferences of the board of directors when the company was founded. The very first year-end date might be chosen to coincide with the year-end of other companies in the industry. This means that the first fiscal year might not be a full 12 months. Say a company is formed in February and decides on a September 30th year-end. Its first set of financial statements would only cover 8 months. But after that, the company would stick with the same year-end date, and all of the subsequent fiscal periods would be 12 months long. It's possible to change a company's year-end, by the way, but it's messy, so you really have to have a strong reason for doing it, like going public or a merger that's going to disrupt the company's financial statements anyway. Many companies never change their fiscal year-end. One more thing. When I say these steps take place at the end of the fiscal period, I just mean relatively soon after the last day of the fiscal period, say within 6 or 8 weeks. The financial statements that are produced represent the situation of the company at the year-end, but the key accounting decisions that affect those statements are made looking back at the fiscal period that's just ended. This means that adjusting entries can be used to tinker with the company's financial results. We'll discuss this in the lesson on earnings management. Even if managers don't engage in any tinkering, large publicly traded companies have to make a trade-off on how much time to take to get the adjusting entries right. If they rush their statements out the door, the adjusting entries will require more estimation because the managers will be missing the information that continues to trickle in after the year-end, such as whether a customer is going to dispute an invoice, or whether the damage to a truck is as bad as it looks. This means that rushing the statements makes them less accurate. However, waiting for a complete and perfect set of information would be self-defeating because that would delay the statements and make them less relevant to all the people who've been waiting for them. Let's take a bit of a closer look at the accounting cycle. This is not going to be as detailed as the bookkeeping video, but it will help you make connections between the things we talked about in that lesson and the various steps of the accounting cycle. The transaction entries are a type of journal entry. These are the combinations of debits and credits that record economic exchanges between the company and other organizations or individuals. The most common transaction for most companies is the sales transaction. We'll be talking about how to recognize revenue and expenses in an upcoming lesson, but suffice to say, every company has to have a consistent policy on when to recognize a sale and how to recognize the expenses that were incurred to make that sale possible. It can get quite complicated when you start to think about things like returns of items a customer doesn't want or warranty claims. There are plenty of other economic exchanges to record, of course, that aren't related to sales. Think about buying new furniture for the office or selling an old truck. Think about borrowing money from the bank or repaying it. Think about paying salaries to the head office employees or dividends to shareholders. All of these transactions need to be captured in the journal. When you're trying to figure out how to record a transaction, the first thing to remember is that the debits and the credits have to balance. This is more of a concern to you as a student than it is to an actual bookkeeper because the bookkeeper is probably using an accounting application that won't allow transactions to be out of balance. If you're writing out a transaction on an accounting exam, though, you have to take the time to check to see that all the debits and all the credits add up to the same amount. The second thing to think about is which part of the transaction is most obvious. If you paid for something, you know right away that the cash went down, so that's a credit to cash. If a customer paid you, then that has to be a debit to cash. If it wasn't a transaction that involved cash, it probably involves something else just as obvious, like a happy customer walking away with some of your inventory. That's got to be a credit to inventory. Figuring out the other side of the transaction might take some careful thought, particularly if you're new at accounting. This is normal. You're learning a new language after all. Just narrow things down one step at a time. Which statement will the other side of the transaction appear on, the balance sheet or the income statement? If you've already got a credit to cash figured out, for instance, is the thing that you got in exchange another asset, like a truck, or is it an expense, like rent? Or maybe you use the cash to clear a liability of some kind, like wages payable or a bank loan. Once you've decided which statement is affected, you need to think about where on the statement the effect will be seen. Is it a current asset or a fixed asset? Is it cost of goods sold or some other operating expense? Then you just need to pick the right account. Admittedly, this is a process that requires lots of practice to get right, but once you get used to recording journal entries, it becomes routine. The adjusting entries are the ones that adjust the values of assets and liabilities to account for the passage of time. Wear and tear has occurred on your truck. Another month of your insurance policy has expired. Your employees have worked for the 4 days between the last biweekly pay date and the end of the month. Interest has accumulated on your bank loan. Note that none of these examples involve cash changing hands. It's not about paying your employees, but recognizing that you owe them 4 days of wages. It's not about paying the bank, but recording the interest that the bank has charged you this month, even though the loan payment may not be due until sometime next month. And finally, note that every example involves both the income statement and the balance sheet. The book value of your truck asset goes down on the balance sheet, and there's a new depreciation expense on your income statement. Lots of regular transactions also affect both the income statement and the balance sheet, but not all of them. Purchasing a truck or taking out a bank loan doesn't affect the income statement. Adjusting entries, however, always have one side that affects a balance sheet account and one side that affects an income statement account. Figuring out adjusting entries is easier in one respect than figuring out transaction entries because you already know which balance sheet account is affected. That's the account that you're adjusting, the value of the truck or the amount you owe the bank. The other side of the adjusting entry has to be on the income statement, and it has to keep the balance sheet in balance. If an asset went down in value, that's a credit because assets normally have debit balances. The other side of the entry, therefore, has to be a debit, which means that it will show up on your income statement as an expense. This is going to cause the retained earnings calculation to go down on the balance sheet, and that keeps everything in balance. The trickiest part of figuring out an adjusting entry is the amount. For transaction entries, the amount is given to you. You know the price you paid for the photocopy paper at the office supplies store. For adjusting entries, however, the amount has to be calculated. It might be 1/12 of the prepaid insurance, or you might have to calculate interest on your loan using a financial formula. These are not impossibly hard calculations, but they do require you to think about what you're doing. Once you've got the adjusting entry figured out, posting it is the easy part. Just make sure the debits and credits balance. I've listed several examples of adjusting entries here. We'll cover all of these in more detail later in the course, but for now, this helps you see that some adjusting entries affect assets and some affect liabilities. Some affect revenue and some affect expenses. Every asset or liability that is affected by the passage of time, and that's most of them, will be adjusted at the end of every fiscal period. Publishing financial statements is the easiest part of an accountant's job if they're using a computer. It's just a matter of pushing a button. Doing it by hand is much harder because financial statements involve a lot of summarizing and conflating. Some disclosures are mandatory, but that doesn't mean that every company discloses the mandatory information in the same way. Some might display their cost of goods sold clearly on the second line of the income statement. Others might bury that information deep in the notes to the financial statements. Every account has to contribute to the totals on these statements one way or another, but most accounts are added together with other accounts to create a low-resolution picture of the corporation. There will be logic in the grouping together of accounts. All the prepaid expenses will go together, all the fixed assets will go together, all the long-term debts will go together, and so on. but there's no requirement to provide a detailed breakdown of the fixed assets, for instance. Property, plant, and equipment is sufficiently vague to suit the needs of many companies. The decisions on these groupings are made by senior management, subject to rules about mandatory disclosures that are imposed by the financial markets, assuming the company is publicly traded. The auditors will ensure, to the exact degree that auditors ensure anything, that the accounts are all classified correctly. You're not likely to find an expense account, for instance, being added to the current liabilities section of the balance sheet. A company's financial statements are prepared by senior managers with the help of accountants. The statements are audited, also by accountants. And the ultimate responsibility for the statements rests with the board of directors, many of whom will be accountants. You may take this pattern as reassuring, but when things go wrong, and they often do, you might also want to think that the accounting profession has a lot to answer for. The closing entry is fairly straightforward. It's simply a matter of applying a debit to every temporary account that has a credit balance and applying a credit to every temporary account that has a debit balance, and then putting a suitable debit or credit into the relevant permanent account to make the whole transaction balance. When you're closing the revenue and expense accounts, you'll put debits into the revenue accounts to bring their balance to zero, then credits into the various expense accounts to bring their balances to zero, and then, assuming the company made a profit, you'll put a credit into retained earnings to make the whole transaction balance. The amount of that last credit will be the same as the company's net income because revenue minus expenses equals net income, and the closing transaction has to balance. The credit to retained earnings makes equity go up. But of course, if there was a loss instead of a profit, there won't be a credit to retained earnings, there will be a debit, and the equity will go down. These aren't the only temporary accounts, but they're the main ones. There are also temporary accounts used for things like declaring dividends or recording all the inventory purchases. These just help the accountants keep track of what happened during the fiscal period. They all need to be closed to the relevant account. Once the closing entries have been posted, the details in the temporary accounts can be archived somewhere for future reference and then purged from those accounts or hidden somehow in the accounting software so that the next period can begin afresh. There's nothing mysterious about the closing entry. Just apply the necessary debit or credit to bring each revenue or expense account balance to zero. Do the same thing for dividends declared, which actually doesn't show up on the income statement. It's on the statement of changes in retained earnings, if you remember those linking statements that I mentioned in a previous video. The balancing entry will go to retained earnings. In the example shown here, net income for the year was $300,000, $700,000 minus $400,000, and dividends were $100,000, leading to an increase of $200,000 in retained earnings for the year. After the closing entry, the revenue, expense, and dividends declared accounts are all zero, but the total of retained earnings is still accurate. If you tried to print the financial statements after the closing entry, the balance sheet would look perfectly fine because those are all permanent accounts, but the income statement would be all zeros. There's really only one way to get this stuff to sink in, and that's to practice. So, I've posted a set of exercises on the website for this course. There's a link in the video description. There are 2 downloadable files. One is a Word document describing various events for a pretend business called Cookbooks. You'll need to create transactions to record each event. The other document is an Excel worksheet where you'll enter the transactions to produce financial statements for the company. The Excel spreadsheet is an alternative way of recording accounting transactions. It's not suitable for a real business, but it can help students understand the relationship between the income statement or the balance sheet, or as it's called here, the statement of financial position. Go to the website, download the files, and have a crack at completing the exercise. I highly recommend it. You can listen to me explain financial accounting all day long, but until you practice it yourself, you won't develop your own sense of how the underlying calculations work in financial accounting. Here's the first page of the transactions in case you're wondering what the downloadable file looks like. And here's the second. You can see that the whole exercise gives you practice at transaction entries, adjusting entries, and the closing entries. Write the entries out in the Word document or print it out and then complete it by hand. Once you've done that, try entering your transactions in the spreadsheet to see what happens. There's a completed copy of each of these documents on the website too, in case you get stuck. Let's review what we've covered in this lesson. We've gone over the accounting cycle both at a high level and in detail. We've learned the difference between transaction entries, adjusting entries, and closing entries. And we've seen how the accounting cycle positions everything so that the financial statements can be published just before the closing entry is done, which wraps things up and clears the slate for the next financial period. We've also had a quick look at the cookbook's bookkeeping exercise. I hope you find it useful. Talk to you soon in the next lesson.
It's all about money, money, money. Ooh, money, money, money. Ooh, yeah. Dollar signs in your eyes. You only wanna make yourself some